Hello and welcome to Annuity 101. In today's video, we're going to go through what an annuity is, how an annuity works, and I'll give you an idea and a framework to think through how to decide if one fits in your overall plan. My name is Doug Aumont. I am a certified financial planner. I am based in Parker, Colorado, and I happily serve clients nationwide. I take an education first approach. So in every discussion that we're going to have, it's going to start with where are we at? What have you thought through? Help me better understand what are your current resources, both your assets, your income sources, what are future expenses, your liquidity needs, help get a bit better sense for your overall goals and objectives. And you'll start to see why. And the reason is an annuity is not designed to be your retirement plan. It's designed, when appropriate, to be a part of your retirement plan. Now, the question that you and I will decide is, well, what specific part does an annuity potentially fit? And we'll talk through a framework today in how to think through the different types of an annuity. And so to start with, there's 4 questions that will set the stage for whether or not an annuity fits. Number 1, we need to know the basics. What is an annuity? And we need to answer the question, well, do I have a specific job for one? And is that job growth or income? Because based upon my answer there, different annuities are going to be applicable. And then most importantly, how do I tell a good one from a bad one? And so by the end of today's video, my hope is that you'll leave with 5 things. 1, what an annuity actually is. The 2 jobs an annuity does. How a fixed indexed annuity protects the principal. How an income annuity pays for life. And most importantly, how do you judge a contract and the company behind it? All right, let's start with the first thing. What is an annuity? An annuity is a contract with a life insurance company. Traditionally, you hand them a sum of money, although to be fair, some annuities are structured with flexible installment payments, but you hand over money to an insurance company, and in return, they put specific promises in writing. Now, there's 2 big promises that the annuity is going to support. One is protection of your principal. This is why people look for solutions that help protect and shield their money from market loss. The second is income you can't outlive. It's taking a piece of your savings and turning it into a guaranteed paycheck for life. Now, as I mentioned, where an annuity fits, you have to give money a job. And so an annuity, like I mentioned, isn't for all of your money. You carve off a defined portion and you give it a specific job so that the rest of your portfolio stays free and unlocks it to do whatever other jobs that you may have for it. And so the risks that this portion of money can help address are really these 3 big ones. The first one, market loss. Especially when you're in retirement, recovering from a sizable loss can take time that you don't necessarily have. Plus, if you're relying on that portfolio for income, it only magnifies the problem. So that first one is protection from market loss, because a bad year, your money may not be able to support. Number 2 is longevity. This is the risk of outliving your savings. If you ask people on the street what are one of the most common fears or concerns they have about retirement, and one of those top concerns that I hear often is, well, I have fear of running out of money. Now, they can run out of money for lots of different reasons. One could be just they lived a long time and they didn't plan for that. And then the third primary risk is sequence, or the sequence of returns. This speaks to, we know over time the stock market, it will go up and the stock market will go down. We just don't know when it's going to go up and when it's going to go down. At the early phase of retirement is the most fragile stage. It's called the retirement red zone. Generally, it's the first 5 years before you retire and then the first 5 years after you retire. And the reason it's called that is because a significant market drawdown can have long-lasting impacts on your ability to generate enough retirement income for the rest of your life. And that is something that's called sequence of returns risk, which we can talk about separately. But that's a risk that is very important that we have a plan in place to solve for. And if none of these 3 risks stand out as a priority for you, well, at this point, an annuity may not make sense. But Stay with me. We'll get through the end and I'll help you understand a little bit more about that framework. But don't just take my word for it. There's been a body of research done by different academics from Dr. David Blanchett, Dr. Michael Finca, Dr. Wade Pfau. There's been studies done by Ernst & Young. Really, a lot of different academic research has gone into showing how adding an annuity to your overall portfolio can actually be an optimal design. And secondarily, on a psychological standpoint, how carving off a piece of your assets that you already have, converting them into an income stream that you can't outlive, it produces cash flow. And people are often much happier spending money that's coming in and being replenished month after month than they are with the challenge of taking distributions from their account. Because when you retire, it's not like someone's going to flip this magical light switch, right? You spent decades being a diligent super saver. You've spent time watching your portfolio grow and watching the stock market, but more as a spectator. Now that you're in retirement, you're all of a sudden, in the blink of an eye, supposed to look at that balance now in a different light. This is now going to be your lifestyle fund, right? You're going to start pulling money out of this account. That becomes very daunting and a very big challenge for a lot of folks, which is why I've chosen to specialize in helping people build retirement income plans that fuel the life that they've always dreamed about, that help give that permission to spend and remove as much anxiety and uncertainty as we can. But as you know, with all things in life, there's no such thing as free lunch. So it's very important as we go through this process. And this is not only something that should apply to your research on annuities, but really all aspects of your life is you understand the trade-offs. And so if you want protection from loss, you have to recognize you have to give up some upside in the strong years. If you want guaranteed income for life, you have to give up some access to your full lump sum. If you want optional riders and benefits, you may have to give up an extra cost or some fees that will be deducted from the account every year. And the question really is never, is there a trade-off? Because the fact of the matter is there's always a trade-off. The better question to ask yourself is this a trade-off that I want? Is this a trade-off that provides more value than the cost, whether it's an explicit fee or an implicit opportunity cost that you might be giving up on something? All right, so the landscape. As I mentioned, really when you boil everything down, there's two primary jobs that you're going to assign an annuity. Now, an annuity is best designed to solve one specific job at a time. People can get into trouble when they try to find like the Swiss Army knife of products that supposedly is good at doing everything. Because what I've often found is a product that claims to be good at everything is often compromising everything as well and is inferior. So instead of trying to find a one size fits all, we give specific money a specific job. And for some, that job may be growth. They're looking to maximize their growth, maximize the amount of interest while protecting their principal. The primary types will be a fixed annuity, a fixed indexed annuity, and a variable annuity. The other job is income, is you want to turn a part of your assets, a part of your savings, into an income stream that you can't outlive. And so the two common approaches there would be an immediate, meaning I want that income to start now, or a deferred annuity where I want income, but I'm still working or I still have other income sources and maybe I want to wait and turn that income stream on in a year or a few years down the road. All right, so let's first take a look at the growth annuity. Again, there's really three primary ways to grow your money. The first, a fixed annuity. It's the simplest, the easiest to understand. A common term that you may see, this referred to as a MYGA. That's MYGA. That stands for multi-year guaranteed annuity. This is very, very basic in terms of how it works. It's a fixed rate of interest over a fixed time period, and you'll know exactly what your balance is going to be at the end of the term. While it's not a CD, and we never want to compare it to a CD because they're different, its most similar characteristics to a CD. I have found in terms of when you're looking at a fixed annuity, generally, if you're willing to hold that money with the insurance company for 3+ years to lock in that rate, that's where a fixed annuity may be appropriate. Next up, I would say on the risk spectrum, and it's not risk in the standpoint of that you're going to lose principal, because again, with these two annuity options that we're discussing here, fixed and fixed index, your principal is protected. What makes it a little bit higher up on the risk spectrum is that the interest that you receive necessarily guaranteed. Now it could be, and I'll explain in a later video as to how that could be potentially guaranteed, but in most cases your index is going to be paid out based upon the performance of some other investment, most commonly tied to like the S&P 500 index, for example. And we know the S&P 500, it could be up one year, it could be down one year. So we're not going to receive a guaranteed rate of interest year after year. The third approach is a variable annuity. This oftentimes is the annuity that when people refer to annuities in a poor light because of the high fees and the complexity, they're oftentimes referring to a variable annuity, but they might be using a generic term like all annuities. Now, a variable annuity is not something that I work with in my practice, and the primary reason why is I have chosen that when I'm working with an insurance company and I'm looking for the guarantees, I don't want my principal to be at risk. So I don't want my account value to potentially drop. With a variable annuity, your principal value could decrease in times that the market or whatever index you are tracking was down that year. And so my practice will focus on those first two, fixed and fixed indexed annuities. All right, moving on. Remember I said there was two primary jobs, growth annuity, and the second one here, income annuity. And really that comes down to, do I want income now or do I want income later? Income now is an immediate annuity. You turn over a lump sum to the insurance company. In return, they start paying you month after month for the rest of your life. And if you're married, you could do joint income for the rest of your spouse's life as well. And same approach to the deferred structure. The only difference is with the deferred is you're giving the insurance company the money now. The payout that they're going to contractually agree to you is actually going to increase every year that you decide to wait. So there's a benefit for deferring. Now, there's also a point of diminishing returns, because if you defer and defer and defer too long, the likelihood of you outliving your account becomes less. And so these are strategic things that we'll talk about, is when is the optimal time to buy an annuity? When is the optimal time to turn on the income stream? And a lot of this might be already predetermined based upon your current income sources and what your overall retirement plan strategy is, but there might be some ways for us to optimize that. And so the reason why people do this, again, is you're converting assets into an income stream that you can't outlive. When you were working or you had a business and you were receiving income, you had a level of comfort knowing that month after month, there was going to be money coming into your checking account to pay for your living expenses. In retirement, there's no such guarantees anymore. You now have your 401k, you now have your IRA, you now have your brokerage account, you have your investment accounts that are now, sole purpose is to providing you income. But you just see dollar amounts, you don't see monthly income figures. And so that's where that challenge comes into play, is how much can you safely take out of those accounts? And if the markets were down, how much would you feel safe taking out at that point? And so really it's an honest trade-off, right? And so you are converting into a level income stream. So let's say, for example, you want 50,000 a year. Well, that's 50,000 year after year after year. Now, at the first half of your retirement, that money is going to go and spend about $50,000 worth. But as we know, with inflation, your purchasing power will erode over time. And so 50,000 won't buy you nearly the same groceries or lifestyle, a decade or 2 decades from now. And so that's why, again, I stress the point that we never want to convert all of your assets into this fixed income stream. We need to figure out what's the overall plan, because we need to have both a plan to grow our money, to keep up with inflation, to maintain our purchasing power. And at the same time, we need to figure out what's our plan for taking distributions and funding our lifestyle. And giving our life meaning and purpose often comes through doing things that we've always planned for, whether that's travel, experiences, being charitably inclined, lots of different ways that you can spend your money. And we want to give you that permission to spend. All right, so to recap, at a glance, the three main types of annuities that I work with. The top two are the fixed indexed annuities. The first one, accumulation, that's a growth oriented one where, again, there's no annual fees. One of the benefits is that there is zero market loss, and you have the potential to receive interest higher than you would from a similar fixed indexed annuity that was targeted for income. The other one, again, fixed indexed annuity with an income rider. Again, this is designed for income, so it's not going to grow. It's not designed to grow like a fixed index designed for growth is. This one is now designed to give you the highest contractual payout, because that, remember, was what we gave this specific pot of money, a specific job. And so for this one, also no market losses. It provides a pension style income, and it's often something that people will use to create that retirement paycheck. And then that third one, the MYGA that I referred to, the multi-year guaranteed annuity, that's the very basic fixed annuity. Again, fixed rate of interest for a fixed period of time. You'll know exactly what you're going to get at the end of it. Some of those annuities will have options for you to take distributions along the way. Sometimes they're 10% free withdrawals. In other cases, you can maybe withdraw whatever the interest that accrued that prior year was. But again, we'll understand what your liquidity needs are, what your goals are for that money, and then we'll find the right annuity to match whatever that specific objective is. And these are those optional add-ons. So again, with an annuity, these optional benefits or features, they are called riders. So it's an extra guarantee. This comes with a price. So where a fixed annuity and a fixed indexed annuity don't have any explicit costs. All the costs are built in, similar to when you go to your bank, right? If you were to give your bank some money and they'll pay you a rate of interest, they're going to pay you a lot lower rate of interest than they're going to charge possibly your neighbor's son for taking out a car loan. And that's how the bank makes money, is on that difference. And so it's called a spread. And an annuity is similar to that, where it's a spread product. The insurance company makes money on how much they pay out in interest versus how much they're able to earn interest on the money that you've deposited with them. And so fixed annuities, fixed indexed annuities have no fees. Those fees come in when you add these additional riders. So the top three most common riders are the income rider. That's where you want to build out your own personal pension plan, creating a paycheck for life. There's a legacy or death benefit rider. In some cases, folks will have the goal of growing their account value, not for themselves, but to be passed along as a death benefit to their beneficiaries, their heirs. And then that third one is long-term care. In some cases, they want to use the annuity as the chassis, the vehicle, to help pay for any long-term care expenses that they may occur down the road. But like I've said, due diligence throughout this process is extremely important. These are not bank products. These are not government-backed products. And so the guarantees are only as good as the strength of the insurance company that's providing those guarantees. So we want to judge the company. We want to look at their financial strength. And we want to look at multiple ratings from AM Best, from S&P, from Fitch, from Moody's. We want to look at what the different rating agencies are saying. Have there been any downgrades in their credit over the past few years? These are things that we want to look for. We also want to look at the size of the company. We want to look a lot about how long has this company been around, right? A company that's larger, that's been around for decades, likely going to be able to weather the recessions, the pullbacks in the market, the changes in interest rates and things like that. We want to know that this company's been through some adverse times and has been able to navigate it successfully. Because again, when we're doing things for contractual guarantees, we don't want the company to go insolvent and have those contractual guarantees be subject to someone stepping in and bailing them out. And then it's very important that we read the contract. A lot of times agents are going to just emphasize premiums, bonuses. They're going to emphasize roll-up rates. They're going to try to get you enticed by different things that the insurance company is supposedly giving you for free. But you're an astute investor, and you know that if it sounds too good, it probably is every single time. And as we talked about today, there's no such thing as free lunch. And so it's very important to look at the contractual guarantees first, the hypothetical illustration second, and realize that reality is likely going to be somewhere in the middle. And so having a framework to think through that is going to be really helpful so that you aren't blindsided by a surrender schedule that you didn't realize existed, for how long it existed, or what may be some fees that you would incur if you wanted to access your money quicker. We want to confirm what happens if you pass away. Does your account value just go to the insurance company, or does it get passed to your heirs? We want to make sure that you understand the full costs that are associated. If there are any costs associated at all, it's very important to understand that. And then this last bullet point, it's kind of something I've coined as like the coffee shop rule. I am really strong on having you be able to be empowered and informed with every decision that you're going to make. And one way to test that is to just practice. You can practice with me first, but really ideally talk to a family member or a friend over coffee or tea or whatever your drink of choice is. And at a high level, you don't need to divulge any of your personal details, but just explain what you're doing and why. And so if you can't explain to someone what an annuity is, why you've chosen one as part of your overall retirement strategy, where it fits, then I haven't done my job in educating you appropriately. And so we want to pause. We want to get to that level of comfort first before you make that really long-term decision that can have some financial consequences if we don't plan for it. And then just some quick red flags to look out for, right? If it's too good to be true, it is every time. We got to be careful of indexes that we have a hard time explaining what they are. We have to be careful of riders that maybe incur high fees. And if we don't clearly understand the value that we're going to get, remember, if the value doesn't exceed the cost, then it's not something we want to pursue. We want to be careful just focusing on the hypothetical illustration. So don't get caught up in hearing an agent talk about this annuity is going to guarantee 12%, because that's bogus, that's not factual. And so we want to make sure we don't get caught up on what it could do, because we can get caught off guard and end up in a product that may not be ideal for us. So again, what we're looking for, you want to be able to clearly name the job that the annuity is solving. You want to look for a strong, stable, highly rated carrier that's been around for a while. You want a crediting strategy that is really easy to understand, that you can articulate and share with someone else. We want to make sure the surrender period, so the amount of time that you're committing to keep your funds with the insurance company, is in alignment with your liquidity needs. And then lastly, we want to make sure the terms are competitive and realistic. And so here are some things that I see, and here's some things that we can avoid where I see annuities maybe go wrong, right? So putting too much in them, as I mentioned, it's meant to serve a specific job within your portfolio. Having a surrender period that's longer than you need. I've seen 15 and 20-year surrender periods. I have a hard time going over 10 years. And so those are things that we'll talk through. What are the trade-offs? Why would I potentially want to lock my money up for that long? Also, using riders that you don't need, right? Having an income rider and a death benefit rider at the same time, things like that. We want to think through and understand the design mechanics of why we're doing it to make sure there's real value. Another one that oftentimes goes overlooked, the way indexes credit. there's a percentage that's going to be quoted. It could be a fixed account percentage, or it could be a cap rate percentage or a participation rate percentage. There's a lot of different approaches. What you're seeing is the year one percentage. Now, these annuities have what's called an annual reset. So every year, that percentage can be adjusted. It sometimes can stay the same, but in some cases it can go up. In some cases it can go down. Where people get caught off guard and end up having regrets over their product is they went with a company that was offering an artificially high, what we call like a teaser rate. And you probably have seen this with other products where a bank may have an offering for a higher CD rate over the first 3 months, but when that CD matures in 3 months and you go to renew it, the rate may be cut in half. Or with a credit card, that may be 0% introductory rate, and then that jumps up to 19 or 20%. Now again, insurance and bank products are completely different. I'm just sharing that as an example because you've seen things like that in your past. You know what a teaser rate is. And so a teaser rate can also happen with these indexes where maybe they offer a high year one rate to get your money. And then year two or year three or some point down the road, they cut those rates substantially. And now you're locked in, right? Because they have a surrender period. And the interest rate that you can receive is much lower than you were expecting because it's much lower than that year one rate. So that's something that we call renewal rate integrity. And we look at the history because a lot of these carriers will publish their history and we'll see which carriers have a history of holding their rates steady. Now, when interest rates fluctuate, that's going to affect what interest rates you're going to receive. Now, not notwithstanding though, we don't want a carrier who's just dropping rates because they artificially pumped up and inflated the first year. So again, we'll talk about that more as we look at Annuity 201 and Annuity 301, but it is one of the more common ways that I see annuities can go wrong. And then the last one, again, we'll touch on this more in Annuity 201 when we talk about an income annuity and how there's an account value and an income-based value, but just leave knowing this. The income-based value is an internal number that the insurance company uses to calculate what your lifetime payout will be. It's not something that you can withdraw and take away. All right, we covered a lot of ground. I'm going to leave you with 3 multiple choice questions. The goal is just to get a quick level set and check in on where you're at. And we'll start with the first one. What is an annuity at its core? Is it A, a type of mutual fund? Is it B, a contract with an insurance company? C, a government retirement account? Or D, a savings account at the bank? Take a second. And if you selected B, you would be correct. It is a contract with an insurance company. And again, the guarantees rest on the insurance company's claims paying ability. This is not backed by FDIC insurance, which is why we want to take extra time vetting out the insurance company that we want to work with. Question number 2. An annuity is the right choice for ... Let's fill in the blank. Is it A, every retiree? B, no one, there's always something better? C, it depends on the job? Or D, only people over 80? And the answer is C. And why is this? Well, again, the annuity is a tool. Whether it fits in your overall plan depends on what specific problem you're trying to solve and if the annuity is the right fit to solve that problem. Again, that could be guaranteed income, it could be principal protection, and so on. And then the last question, get another fill in the blank. In exchange for protecting your principal, a fixed indexed annuity does what? Does it A, pay the full market return? B, limit your upside with a cap or participation rate? C, guarantee you'll beat the market? Or D, charge a yearly market loss fee? And the answer is B. The most common approaches that I've seen, again, is it limits your upside using what's commonly referred to as a cap rate or participation rate. As I mentioned, there's other crediting strategies. These are just 2 of the most common approaches. So this just stresses that point that there is no such thing as free lunch. You're getting your downside protected from market losses, which is great. And then when the markets are up, you're locking in those gains so that in a subsequent year, if the market does go down, you're not losing. And there's a trade-off for that protection. That trade-off is when the market's doing great, you're not going to participate in the full upside of the market. So the bottom line is this: the right annuity is not about chasing a product. It's matching the right contract to the right job. So when you're ready, the next step will be to continue your education. If you prefer to just do self-guided education, I will provide you with access to Annuity 201 and then Annuity 301. But along the way, I invite you to schedule a complimentary one-on-one session with myself. Again, Doug Aumont. I'm a certified financial planner. And I would love to think through your overall retirement goals, your retirement strategy, and help to see whether or not an annuity potentially fits in your overall plans. And lastly, I want to leave this up on the screen for a minute. The short version is this: today was education only. I am not your personal financial advisor. I am not your tax advisor, and I am not a legal advisor. So please note that everything was provided for educational purposes only. None of what I shared today is tax, legal, investment, or financial advice. And again, these are insurance products issued by life insurance companies. They are not government-backed products. They are not backed by FDIC insurance. And so they are also treated as long-term and subject to IRS rules in terms of distribution rules and tax rules. All of that will be shared with you, and it's very important to know before you make any decision, because like all products, there's going to be trade-offs. We just need to understand what those are and if they're appropriate for you. Well, thanks for taking some time. You made it all the way through the end. I appreciate you for that, and I look forward to catching you on the next video.